All righty. Good afternoon, everybody. This is Dan Sheridan. Welcome to free webinar for today. And hope you're all well. Glad to have everybody here today. Let me just say a couple introductory remarks. This coming Tuesday, we're going to be starting a 4-week class on credit spreads. It's going to go from June 2nd, which is this coming Tuesday, and it's going to go through June 25th. And we'll be going Tuesdays and Thursdays at 1 p.m. Central. Minimum class time will be about an hour. So it'll be about 8 hours of live content. The class will be $397. It'll be live, but if you're working or can't make it at that time, they'll be available on recording a couple hours later. And all the every class I'll be putting on a live credit spread so you can get the mechanics of how to do it. So we can work on the craft for 4 weeks together. And Johnny put a link in there. You can go to SheridanMentoring.com on the front page, get some more information and sign up for that. So I just want to make a few comments on credit spreads, and then Lee mentions it's new and I'll explain what a credit spread is. But how many of you, my desire to do this class has come from a couple things, but one is, how many of you would be thrilled as pie if you could become efficient at one strategy for weekly income? Just one, to bring in some type of it, just one, right? You know, there's many strategies and options. I picked the strategy for many reasons, but I picked this because it's simple. You know, it's a pretty simple strategy, something that we'd be looking at putting on every week, methodically put on every week. And I mentioned we're going to help you with a plan to make, the plan is to make 5% weekly. Where did I come up with that number? Well, let me ask you a question. If you're doing, let's say, for example, you do a credit spread, and we'll show you a couple examples of it. When you're doing short-term credit spreads, maybe 7 to 15 days, and you're going to be able to get out of them every week. In other words, if you do a 30 or 40 day trade, are you usually going to get out in a week? No, maybe longer. So you're able to put 5 trades on. A typical credit spread might be, again, there's different ones, right? The ones I'd be looking at in class might be $1.50, somewhere around there, a little bit more or less. A typical example would be $1.50, and the risk or the capital on that would be about $8.50, right? So what would be the potential return? If you're doing a credit spread for $1.50 and the risk or capital is $8.50, it's about 17% return, right? Now we'd be looking for less than that, maybe 8 or 9% in a week. And so with losers and winners, you know, we'd be looking for around an average of 4 or 5% over time per week. It's because of the turnover. And again, so what I'm looking to do is give you a simple, explain the strategy, and help you over the 4 weeks so that you can do it yourself. In other words, we do it together for 4 weeks, a simple plan, whether you're a beginner or advanced. In the world of options, many people are jack of all trades, master of none, and they don't develop the craft. What do I mean by that? What I mean is you got all these different strategies, but you know, if I say, hey, are any of them you generating you know, $500, $1,000 a month or a week on a regular basis, it'd be no. So the goal here is that we get you started on one strategy, and then you go from there. It's almost like we're saying, I'm just looking at the names in the chat here: Seth, Jim, Art, Lee, Petru. Hey, we're going to be your personal trainer for 4 weeks. We're going to come to your house. We're going to show you the exercises to do. We're going to knock on your window, like, remember Ernest T. Bass and Andy Mayberry? We're going to throw rocks at your window at 6:30 in the morning. We're going to get you out of bed. We're going to show you the strategies. We're going to do them side by side with you, right? We're going to make sure you do them, make sure you do it the right way so you don't hurt yourself. And then we're going to do it every other day for 4 or 5 weeks, right? All right, we're going to do it long enough so that you've kind of got it. And when we disappear into the sunset, not that we want to disappear, you can do it, right? And we're trying to develop a habit. Don't tell anybody, but our goal is after 4 weeks, you're starting to develop a habit, right? Like Dino said, it's good to know several strategies. It's best to learn them one at a time. Agree. And so what we're trying to do, we'd like you to get to more strategies, but what we'd like to do is get one strategy. Now, in terms of capital, which Lee mentioned, again, here's the key. I don't know everybody's level of expertise with options. If you're never done this before and you're new, I would like you to paper trade for a bit, a couple weeks or so, just so you know you can trade alongside, but do paper trade, right? We want to make sure you know what you're doing. But if you've done this, maybe you could, if you have the expertise and you could do one contract. But I would say the capital could be, again, you can do one contract for some credit spreads you can do for 800, some you can do for 400 or 500, some 1,600. I would say if you have a couple grand in your account, that would be fine. So you don't need to have enough capital to buy the Mona Lisa in your account, right? You have a couple grand in your account, you're fine, right? Again, forget the size, right? You're going to do the same print. When I was in the pit trading in Chicago at the CBOE, I started out when I was being mentored and taught to do one contract and 5 and 10 and 1 and 5 and 10 and get good at that and slowly build up. And so at times when I was doing, let's say 1,000 contracts, or at times 5,000 contracts at times, was it bigger? Yeah, but it was the same mechanics. Do you know what I mean? It was the same thought process. You're aware you're doing bigger size, so you need to be in liquid vehicles, and that's what we're going to talk about. But anyways, that's the 2 cents on that. This will be the way we'll be teaching it, very mechanical. Again, during the 8 weeks, we'll talk about this credit spread system. We'll talk about adjustments and different things really strengthen you and build you up. But ultimately, what I want to give you is a very simple system. But even in that simple system, it's very powerful risk management in there to protect you. And the system that I'm going to be showing, we're going to have like Jay Bailey, who works with me, is one of the best credit spread traders I've seen in terms of giving you a system. So he's going to give you something a little more directional, which is a great system. I'm going to give you something more mechanical that you can do. But this is also something you can do. How many people trade? How many people trade in their retirement account? How many people where they're trading their options is in their retirement account? Okay, and so what's perfect about this is a system. This is something that, in your retirement account, at least a system I'm going to go over. which way does the market want most of what you guys have in your retirement account? A lot of you have stocks and stuff, but most of you, would you say in your retirement account, which way do you want the market going? For the stuff in your retirement account, which way do you want the market going? And so what this is going to be, this system is going to be something that, at least the system I'm going to teach, Jay would be a little more speculative, but what I'm going to teach is more something that for your retirement account, it could benefit from the market going up, but we're going to have, as Barney Fife would say, we're going to nip it in the bud. Remember Barney? On the downside, right? And again, we're going to talk about if you do put credit spreads or long stock or covered rights, your risk is on the downside. And so we're going to help you how to deal with the risk and weatherproofing your credit spreads, even we'll talk about for big moves. So we're going to talk about all those things. Like Art said, I'm all cash since March. How many people are still scared of the market? Yeah. Kel says he's scared. Yeah, I'm scared a bit too. But what we're going to show you is, let me ask you a question. Against a credit spread, right? Petru says he's scared of a black swan event. What if we, are there ways with options to eliminate, right? I mean, in other words, are there ways with options to eliminate the downside risk or cut it down so that if you had a gray swan, a blue swan, a purple swan, a yellow swan, or a green swan, you'd be okay? Yeah, right? So that's what we're trying to, everything Sheridan Mentoring or anything I've stood for since I've been trading is one thing: risk management. And that's, when you look at a lot of people, I'm sure you've seen credit spread services and you've seen credit spread subscription services and all that. My goal is to teach you to do it yourself. And my goal is that by the time you're done, if you apply these principles, you can do better than any credit spread service out there because you're going to have really good risk management. A lot of credit spread systems that I've seen, probably 99% of them, what they propose you do when the market goes down scares me in my big toe and my little toe, right? They talk about rolling the bad side out or rolling it and all this and rolling. Well, how do you think that went for the first 3-4 weeks of this down move? Anything but buying a put or getting out. Do you think the rolling, anything where rolling just means that you're moving the spread further out of the way, hoping that the market comes back, right? And what we're trying to do is, let's face it. What we're really trying to do is help you. If you do, we're looking at high probability credit spreads. If you do this all year, you're going to win probably 80% of the time. But what we're trying to keep it, when you lose, you don't lose more at the most than 1 times what you're making. Does that make sense? Right? You can have baboons at Brookfield Zoo in Chicago that could put a credit spread on, but you can't have baboons from Brookfield Zoo manage them, right? And so the key is, for any of you who've done credit spreads, it comes down to a couple things, doesn't it? Tell me yes or no. Being consistent, right? And keeping your losers under control, period, right? But I'd say, and I mean this sincerely, I'm just 99% of the credit spread systems or newsletters I've seen, I wouldn't stink and go near them. Say, why, Dan? Well, again, any baboon from Brookfield Zoo could set up a credit spread and get high probabilities, but they can't manage it, right? And I'm not saying I'm as good looking or better than a baboon from the zoo, but the point is, right? The point is, you don't want to have a risk management system that once every 2 years you lose 6, 7 months of income, right? And so, and I'll go over in detail, right? All the different adjustments just to flag them for you. So when you see newsletters and subscription services that have these type of adjustments, I just want to be clear. If you give you my 2 cents on them, right? Give you the reality, tell you how they would have done the first month of this correction, right? And just so you're aware, if you choose to do them, right? If I tell you not to walk across the highway during rush hour, and I explained why you shouldn't walk across the highway at rush hour, and you decide to do it, okay, hey, right? I talked to you, I explained to you the risk of walking across the highway at rush hour, and you still decided to do it to get a thrill, right? Anyways, so we're going to try to make this the most practical class you've ever had. Make it clear. We're going to give you a simple system, but we're going to spend a lot of time teaching you the why behind it, right? In other words, there's nothing mystical. I'm not going to come in here and say, I've got an algorithm that I developed in a cave in India, right? And there's only me and one other person that developed, it's baloney foot, right? It's very easy to get probabilities. But again, management is the key. So that's the class. We're going to try to equip you what strike, what vehicle, the width of the credit spread, when to put it on, when to take it off, when to eat, when to go to bed, everything, right? But again, it's simple, right? Simple to do, but it's all based on, and what's nice is when you do a credit spread, do you have risk in both directions? Yes or no? When you do a credit spread, do you have risk in both directions? No, you have risk in one direction, which I'd rather have one enemy than two. So I think this is good for even a beginner or advanced, because advanced, whether they've done it a lot, if they're using risk management that eventually is going to cost them a problem, I got a big problem with that, right? Let's look at a few examples. So first I want to talk about the market, and then let's dive into credit spreads. This is a price chart in Thinkorswim for the last 6 months, right? And here's where the avalanche started, right? Everybody familiar with that? The COVID correction. And this was like coming into, before that, this is like December, January, February. It's like walking up to Niagara Falls and then falling off. Agree? And we'll also share a lot of indicators and things that, as you're going along here in a very range-bound market. Again, this is a price chart. I'm using Thinkorswim, which is what you almost hit these days. You have to say, well, this is a Thinkorswim price chart, which is now under the realm of TD Ameritrade, which is now under the realm of American, well, what's the next options? Charles Schwab, right? Isn't that who bought Thinkorswim or TD? You're basically, I mean, it's good and it's bad, but it's like 10 years ago, how many brokerage firms did we have specializing in options? 10 years ago, how many brokerage firms did we have specializing in options? Here's an answer. A lot, right? And how many do we have now? A little, right? Because a lot of the big firms, right, have bought a lot of the other firms. How many of you think that's good or bad, that there's only a few firms left? How many of you think that's good or bad, that there's a few firms left? Not so good, because service, it becomes, I'll just give you my journey, or give you an example. I think I have some brokerage accounts at maybe 3 different brokers, but yeah, probably one of the predominant ones we use is Thinkorswim, TD Ameritrade, or Schwab. Well, when Thinkorswim was Thinkorswim, Tom Sosnoff and Scott Sheridan were in charge there. And boy, we could call up and talk to them. We could, service was like beautiful, right? When TD Ameritrade bought Thinkorswim, after a while, it became more, what's the word that begins with a B? Bureaucratic, right? Right? It became, there's still good people over there, but more layers. And now with Schwab, I can't even imagine in 6 months or a year what it's going to look like. Now, I could still use the platform, but it's much more cumbersome. It's not horrible, right? I'm not, don't get me wrong. I mean, they still have a lot of the, when you go to Thinkorswim in Chicago, a lot of the, there's still some very good people there. But, those things happen. So as we look at the market right now, kind of here's how I'm looking at things. We're kind of been in a range, but we've kind of busted out a little bit this week. Do you agree? We kind of, I think it was Dino or somebody in the community, someone told me yesterday, but it's like on the upside, we kind of busted out a little bit here. The 200-day moving average is about 3,001. And we're pretty close to that, right? We're about 30.26. We busted above there. I think, again, I don't know much about technicals, but a couple of guys in the community told me there's like a Fibonacci. It sounds like a good Italian beef sandwich. There's a Fibonacci number like 30. I think Steve Basiago said 30. What was it? 3039. I think that was the number. And we've been in a volatility range of about 27 to 40. And I think we'll continue in that, right? I want to bring up a chart of VIX here in a second. And this is kind of driving what strategies we do and stuff. But for the credit spread system, I'm going to put it on every week, right? I may tweak it a little bit. But again, here's an amazing statement. If you're looking for weekly income or monthly income, do you need to trade? Yes or no? Yeah, it has to be a deliberate, intentional plan, right? So again, my goal is for those of you, if you said to me, what's one of my main, the main goal at Sheridan Mentoring for 14, 15 years has been, and we've stayed with this, try to help people become independent, right? I've stayed away from getting into management of money. We really haven't gone down the road of, which everybody does, subscription services. Many students that I mentored at Sheridan Mentoring have gone off and, all taken similar strategies and subscription service and all this. For me, the burden has always been trying to help people be independent. And it's not easy, right? It's easier to just follow. Isn't it easier to just follow somebody? Even though I'd say 90% of the time, and I mean this, most of the people I've seen, their risk management is what separates them. And again, it might take a year or two to flush the market out. We had an 8-year up market. So anybody who had strategies that were more focused to the upside, nothing really showed up until the last 3 months. Then you see that the risk management maybe wasn't so good. So anyways, so let's look at a few strategies. So here's an example of a spread. What is SPX right now? SPX is down 1 point. Okay, so we've rallied a little bit. So we go over a couple examples. So first of all, here's a 7-day, and let's talk about this. So here's a 7-day iron condor. Excuse me. Did I say 7-day? 7-day credit spread. So we're right now at about 30.28. And what is a credit spread? Credit spread is you're selling, just using this, selling one. If it's a 7-day, here's June 5. That's a week from this coming Friday. 29.20 put. And buying one. 29.10 put. And this is going for a credit of around let's call it $1.50. Easier math on that because it's going up, it's going down, and we've moved a little bit, but I think this would be typical. So when you do a credit spread, if someone said to you, what's the reason you would do a credit spread? Right? What would you answer them? Why would you do a credit spread? Petru says he's bullish, right? Directional. That's good. You want to, right? Yeah, so if you do it in the puts, it's directional to make money. But one thing I'm looking for, what about something called, do you need an edge? If you're going to open a business, do you need an edge, right? What's the edge? It's a word that Becky got it. If you're going to open up a business, you better have an edge, right? Doing credit spreads because you want to make money is like, no. Probabilities. So when you do credit spreads, you can set up credit spreads that, regardless of direction, the probabilities are in your favor, right? Agree? So it's a probability-based trade. Now, in other words, most of the credit spreads we're going to talk about in the class will be about 75 to 80% probability. Now that's 75, 80% probability without getting involved with direction, right? So all a credit spread is you're selling, if SPX right now is at 30.28, and I think when I was looking at these examples, it was a little bit lower, but here I'm selling an out of the money put. That's the whole thing. So forget the hedge. I'll call this a hedge. So let's just focus on this. I'm selling a 29.20 put. And what do I mean it's out of the money? If we're trading at 30.28, the 29.20 put is 100 points or so out of the money. Agree? 108 points out of the money. The expiration is this Friday, a week from today. So if I just sell the put, how do I make money? Right? I make money if we don't close under 29.20 in 7 days. I make whatever I sold this put for. Does that make sense? So the whole reason I'm doing a put credit spread has nothing to do with the credit spread, nothing to do with the long put. I'm simply selling something out of the money and getting probabilities in my favor. That's the foundation. Does that make sense? What is a credit spread? The foundation of a credit spread is I'm selling an out of the money put far enough out of the money that I'm getting the probabilities in my favor. What does that mean? So let's just say, how would I pick a short strike? Let's just say, for example, the delta of so how I might pick the short strike. Let's say I picked a short strike and I say I'm looking at a delta of 20. What does that mean in English, Spanish, or Portuguese? What it means is if I'm choosing a 20 delta put and I sell that put, and let's just say this was 20 deltas. I forget exactly which this one was. What does it mean? It means over the next 7 days, the life of this trade, there's only a 20% probability we're going to finish under 29.20. If you flip that around, there's an 80% probability we won't. Okay? So if I just sell a 20 delta put every 7 days out, forget the direction. Are the probabilities drastically in my favor? Yes or no? If I do this for the next 432.7 years. Yeah. Right? Any monkey can do that. Agree? Right? You guys can do it. You need me for that. Right? You can go sell puts all day long. Now, why are we having a discussion today, right, of credit spreads? And a spread is just buying something to hedge against it, right? Right? And Rick made a good point. Also, a 20 delta put means you have this phrase probability of touching. On a 20 delta put, there might be a 40% probability of touching that short put during the expiration. But what's the main reason you don't just naked sell a put? Why don't I just sell one of these every week? What is a problem with that at your brokerage firm? Your wife or your husband is going to come into your room the next day and say, is this right? Is this right? You're going to say, what do you mean? You told me you only sold one put and they're charging you an arm, a leg, 2 toes, and 3, and we have to put up 3 of our kids as collateral, right? So now, do I know a lot of good people who do just sell naked options? I do. Right? Would I ever teach it? No. I mean, if you're a professional and you have a portfolio margin account, a portfolio margin account is more risk-based. So, but the bottom line is, if you asked me more than anything, right? I mean, I'm decent at managing risk. So I'd have no problem, and I've done it before in the pits, maybe selling a naked put. But the main reason, to me, even if someone really is good at managing the risk, that I would not do a naked option short is one reason. I mean, the risk is up there, but the main reason is the yield. Isn't the name of the game to make the best yield on your capital? Yes or no? Right? Isn't the name of the game to make the best yield on your capital? Right? And again, I think as far as, unless you're very, very experienced, I would stay away from trading futures options with credit spreads or naked options, or even a portfolio margin account. Let me just say that again. Unless you're very experienced, right? I would stay away from futures options or portfolio margin accounts if you're selling any naked options, right? Say why. Here's my answer. Because of what happened in February and March. Is that enough to say? Right? Is that enough to say? Right? Would that have been a pleasant experience for most people selling naked puts? Yes or no? Would end of Feb, March have been a pleasant experience? Yes or no? No. I think what I'm going to do during the credit spread class right? And I haven't even talked to him in probably a year. But I'm going to have on a friend of mine, and I will do this, right? During the credit spread class, I'm going to bring out a friend of mine, Peter Klink, longtime CBOE trader, very good trader. But Peter Klink has an interesting job right now. Does anybody know what Peter Klink does? Anybody? Anybody know who Peter Klink is? Now, I don't mean who's the guy from Hogan's Heroes. Who's the guy from Hogan's Heroes? That was Klink! Colonel Klink. Yeah. So Peter Klink is for probably 20 years, he is at Schwab, TD Ameritrade, Thinkorswim. He's at Thinkorswim. He's the head numero uno baguno, head guy in their portfolio margin and risk department, right? He's the guy, right? So, and we'll bring Peter on and we'll talk to him about a few stories of naked options. Do you think he'll have a few? Right? Do you think he'll have a few? I think so. So Peter is in charge. So he deals with people that do naked options in the portfolio margin. And I think my guess is when you hear a couple of his stories, it will sober you up, right? That risk management is number one, number two, and number three is it being an option trader. All right. So again, somebody said Peter is overkill. No, I'm not going to have Peter come in here and explain the algorithms behind portfolio margin. I'm going to have him just give I'm just going to ask him a Q&A, right? Directed at beginning and retail traders that I think will, it'll be the equivalent of, how they bring teenage kids that are maybe thinking of doing some wrong or maybe have done wrong. They bring them to jail cells. What's that called? Scared straight? Yeah, this will be like scared straight for you guys. You ready for that? This will be your scared straight exercise with Peter. All right, so again, buying a put in a credit spread is strictly a hedge. Agree? If you have a smaller account, you could buy your put 5 points away from the short. Predominantly, I might do it 10 points away. Some people do it 20 points away. We'll go over the pluses and minuses of the different ones. It's just for a smaller account. If you're coming from paper trading to just starting, I'd go 5 points wide. And we like really liquid vehicles. So you can get in and get out. SPX, probably the number one I'll talk about. That's where I will do most of the system. SPX is in an index of 500 stocks, less volatility than most stocks. And you can do it in, if you want to do it in liquid stocks like an Apple or Amazon, I think those are fine too. But I like SPX. You don't have that stock risk, right? So again, for this example, let's just say on this credit spread, I get $1.50 credit. Just using an example just to discuss. My risk would be about $8.50. How did I get that? Your risk in a credit spread is simply the distance between the strikes is 1,000. 1,000 less your credit is $8.50. So this is the credit. This is the margin. So if you take this divided by this, what's going to be your potential yield at expiration? 150 divided by 850, about 17%. And so again, the goal during this course is you're going to do this for 4 weeks, right? And the goal is, and we'll give you some, you start with 1, you build up to 3, to 5, to 7, to get up to about 10 contracts, right? And your goal is to get, you're looking to create a profit center, right? per strategy. So for this, your goal might be to get up to 3,000 or 4,000 a month, right? That's your goal. Agree? And now, let me just give you a point on increasing the size. I've been mentoring now since 1994. I think that's, no, 2004 I started. So what year is this? 2020. So 16 years. And the thing that's unique about Sheridan Mentoring, when we're dealing with the students, it's all on live trades, right? We're trying to help them become independent. Independent traders. But in terms of increasing your size, here's what I've noticed. A lot of people that have done 1 or 2 or 4 contracts for 6 months, the first 6 months, the second 6 months, they might go from 6 contracts to 30. I'm not saying it always, but here's the point. The foundation is everything, right? Do you agree? Foundation is everything. Once you build the foundation, once you build the foundation and you have it down pat and you're doing it on 1 contract, you can increase your size much more. You don't need to go, 1 contract for 6 months, 2 contracts for 6 months, 3 contracts, 6 months. You'll be 117 by the time you get up to 10 contracts, right? So it's the foundation, that first 2, 3, 6 months foundation, and doing it the right way. Agree? And what we're trying to do is get you the right way. If we had the other 2 mentors, Jay Bailey and Mark Fenton, who have both been with me, 12, 15, almost the whole time I've been doing this. But, we don't have many students that are trading live with us during the mentoring, that during the 6 months, and it's all on live trades, we don't have many at all that are down money at the end of 6 months. Where sometimes the problem is once they're done mentoring after 6 months or a year, some of them go off the reservation, so to say. You know what I mean? It's no different than, if Lee or Brendan or Jim, let's say I was a fitness instructor, which obviously I'm not. While you're with the fitness instructor, why do you get up at 6:30 in the morning? Why do you do what they say? There's accountability. Do you agree? There's accountability, and it's easier to show up than to have him call you up and say, Lee, why didn't you show up? And it's the same principle here. During the mentoring, people show up and they're going to do what you tell them. And, and it's really about following guidelines. So when you look at a credit spread, other thing I want to point out here is, so it's long deltas. So this particular strategy starting out 1.8 deltas or 1.79 deltas long. What does that mean? What does that mean? It means if you look at the graph, this is the expiration graph, right? Right, would be in 7 days. And this is the graph today. So over 7 days, this purple graph will merge into the green graph, right? And you can see the profit line. This is 0, this is negative, this is positive. So it's long deltas. What does that mean in English? This is close to 2 deltas long. It just means that for every dollar you go up, again, the easiest thing if you're learning to think of the word deltas, think of terms of stock equivalent. If you're long two shares of stock and we go up $1, you make $2. If you own 100 shares of stock, it goes up $1, you make $100. If you own 200 shares of stock, it goes up $1, you make $2. If you're 2 shares long, or you have 2 deltas long, it goes up $1, you make $2. That's kind of delta and gamma refer to price risk. Theta is time decay, and vega is volatility risk. So just like a pilot in the cockpit, this is kind of what we're teaching you, and really what we've devised this system around is the Greeks and how they affect you, right? You know, one of the things you notice here is, do you agree? It's at expiration, you could see, you know, if this is where SPX is here, and this is your short put, let's call it 29.20. Did you ever notice? If we go to the short strike the first day you put it on today, is there a problem? Yes or no? If we go to your short strike today, is there a problem? It's the expression, Houston, we got a problem. If we go to your short strike on expiration day, or if we go there, it's a lot different in terms of P&L. Now, but your short strike is 29.20. Is it a high probability that we're going to go to 29.20 in one day? Yes or no? No. The delta might be 20, maybe a little bit lower. No, but could it? It could. So definitely this system that I'm going to be talking about more next week. And again, we're not just going to talk about a system. We're going to talk about, I want to educate you too, but we want to give you a lot of practical experience. That's why we'll be doing live trades every class. But it's based on probabilities, but the success of it is going to be the risk management, right? You know, because if you're doing something for, and again, we can talk about different credit spreads, but if you're making 150, but your risk is 850, right? And let's say every week we make 75 bucks. What return would that be? So if this is your credit and this is your risk, if every week we're looking to make $75, what yield would that be? What's 75 divided by 850? Anybody know? It's about 8.8%. But let me ask you, if you're running this business, this credit spread business, and when you win, you're making 75 bucks on capital of 850, that would be typical, 8.8%, and you lose, and let's say your risk management is closing your eyes and saying like Dorothy in Wizard of Oz, I hope the stock comes back. I hope it comes back. I'll be good to my neighbor. I'll be good to the poor kids in the neighborhood. Oh, if it just comes back. How many of you have had a hope, at times, a hope risk management plan? It'll come back. And you can justify it by, you know what? There's a Fibonacci number. There's a Fibonacci number. There's a Parmigiana number. There's a Fettuccine Alfredo number, right? It can come back. But that's not risk management, right? And so if I'm making 75 bucks every week that I win, and when I lose, I'm losing $500, right? Is that a system that I could sell to an institution? Hey, we're going to win a lot, but when we lose, we're going to lose 7 times what we make, right? Would that work? No. So that's really what we're trying to teach you next week, really is the most important things that we're going to teach you. The risk management. You didn't need to go to Harvard or Yale or Oxford. But you need to be able to follow guidelines and rules, right? And we need to teach you enough to know that there's certain things with put credit spreads, right? There's a lot of geniuses out there, right, that have been trading for a long time that had some very questionable risk management techniques on the downside, whether it be iron condors or credit spreads. But in February, were some of those techniques exposed? Yes or no? Right? Yeah. And again, Shammy says, if the market's down 100 points, how do you manage risk? Again, that's what we're going to focus on, is giving you a plan, whether it's down 100, 200, 800, 52,000, or whatever, right? These are defined risk spreads. But the main way we manage risk is, here's the answer. It begins with a P. What's the answer? What's the answer? It begins with a P. That's the start of it. We have an intentional plan, right? It's not a prayer, but a plan, right? And we'll show you how to weatherproof these. And do that. Again, most of the credit spreads that we would be doing, now again, is a 100-point move. Let me ask you, is a 100-point move gap, or 100-point gap it, or 100-point move in the SPX, right? Is that normal? Yes or no? A 100-point move is not, right? And most of these strategies, the strategy we'll be talking about, they can handle a gap. But again, you know, if you have a 100-point move, can you lose money? Yes or no? Yeah, and that's okay. But again, how many 100-point gaps move have we had in the last month? How many 100-point gap moves have we had in the last month that we couldn't defend against? Here's my guess at my answer. 0. Right? It's all dealing with insurance. That's risk management, and we'll teach you that. Right? If you're concerned more as you get, that's the beautiful thing with options that you can't do with stock, right? If you tell me, Dan, I don't want to lose much if we have a 15% gap move. Done, right? But are there two sides of that, right? Are you going to give up some yield if you want totally insured? Yes or no? Right? Say, Dan, I am so scared of February. I want to do the put credit spreads, but I want a 0 deductible. Done. Done. We have another big move like February. You're sitting at the beach drinking pina coladas. But it's going to cost you a little more. You'll give up some yield. So again, there's no right or wrong answer. But I think a lot of the fear comes from understanding. So what we're trying to do is strengthen you, build you up with these. Anyways, I'm excited about it. I think this is be a great class that gives you a chance to get really good at one strategy. We start Tuesday at 1 Central. Again, maybe some you can come live. If you can't, we should have it up. The class should be available about an hour after practical purposes. If I'm doing live trades, it's just I'm trying to be transparent, show you, deal with execution and everything. And all the classes will be available for archived. You can send it. If you watch it later, you can. There'll be a button on the archive page with the slides that you can ask me questions. And again, it'll be archived up months and months after the class. So folks, look forward to seeing you. If you have any questions, you can email me, dan@sharedandmentoring.com. Appreciate everybody showing up, and we will see you bright and early, not too early, on Tuesday for the start of credit spreads. I think it'll be a great class for you. Thanks again. Bye-bye.